All right, let's jump straight into this explainer. As an investment analyst, there is absolutely nothing I love more than taking the market's current pricing and aggressively stress testing it against the bedrock principles of finance. Today, we're taking a massive utility stock, American Electric Power, or AEP, and putting it through the ultimate valuation gauntlet. We're going to rigorously apply the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then cross-reference all of that with modern quantitative models like discounted cash flow. It's going to be a fun one.
So here's our game plan for today. We'll start with a quick AEP company snapshot, then move through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll hit the DCF and alternate models before wrapping it all up with our synthesis and final recommendation.
Okay, Section 1. Let's get a quick snapshot of the company.
To really understand AEP right now, you honestly only need to look at one staggering number: $78 billion. AEP recently bumped up its 2026 to 2030 capital plan to a massive $78 billion. This is entirely driven by huge transmission investments and an expected 63 gigawatts of incremental customer load commitments by 2030. And a lot of that, it's heavily fueled by energy-intensive sectors like AI data centers. They are literally building the infrastructure of the future. But, as we're about to see, that kind of growth comes with a massive price tag.
Currently trading at $134.94, American Electric Power is one of the absolute largest electric utilities in the United States. We're talking about delivering power to 5.6 million customers across 11 states. That gives them an incredibly wide, regulated footprint. With a market cap hovering over $73 billion, this is a true titan of industry. But the real question we have to answer today is, does a great company currently make for a great stock?
Let's move to Section 2 and pass this through our first filter, the Warren Buffett lens.
So how does AEP stack up for the Oracle of Omaha? Well, it easily passes the moat test. It's a regulated monopoly operating the nation's largest transmission system. Management is executing well, reaffirming their guidance, and they maintain a very steady 13.05% return on equity. But, and this is a big but, we have to look at the debt. A debt-to-equity ratio of 1.89 is undeniably high, and Buffett, as we know, strongly prefers unleveraged balance sheets.
This actually brilliantly illustrates the classic utility paradox for a Buffett-style investor. Think about it. On one hand, you get incredible earnings consistency because the government basically guarantees your return on investment. But on the exact flip side, achieving that requires taking on massive debt to fund things like that $78 billion capital plan. Buffett famously focuses on owner earnings. That's calculated as operating cash flow minus maintenance capital expenditures. Because AEP's massive capex needs basically consume all their operating cash flow, their true owner earnings are negligible, maybe even negative in the near term. To compensate for this reality and that heavy debt load, Buffett would demand a steep margin of safety. At $134.94, he'd very likely pass and wait for significant pullback.
All right, Section 3, let's pivot and view AEP through the Peter Lynch lens. In Peter Lynch's famous categorization system, a massive regulated utility paying a 2.82% dividend yield fits perfectly into what he calls the stalwart or slow grower bucket. You definitely don't buy these expecting a 10x return overnight. You buy them for the steady earnings protection and those reliable sleep-at-night dividend payouts.
Now, this number is crucial. AEP's PEG ratio, which is its price-to-earnings ratio divided by its growth rate, is currently sitting at an elevated 2.46. For Lynch, the PEG ratio is essentially the holy grail of valuation because it levels the playing field between those slow growers and the fast growers.
A PEG ratio of 2.46 is a glaring red flag in the Lynch framework. He's looking for a PEG ratio closer to 1.0, meaning you're paying a totally fair price for the underlying growth. Plus, Lynch loves pristine balance sheets, but AEP's debt to EBITDA sits at a hefty 5.91. Combine that heavy debt with the fact that institutional ownership is already crowded into these mega-cap utilities, whereas Lynch always preferred under-the-radar stocks, and AEP would likely trigger a clear pass or even a sell rating under his strict criteria.
Moving into Section 4, let's consult the godfather of value himself, the Benjamin Graham lens.
Let's run AEP through Graham's defensive investor checklist. It easily passes the tests for adequate size and earning stability. But then it just hits a brick wall on valuation and debt. Graham demanded strictly moderate valuations. He wanted a PE under 15 and a price-to-book under 1.5. AEP's PE is currently over 20, its price to book is 2.32, and its net debt to EBITDA of 5.85 fails his strong financial condition test. By Graham's standard checklist, AEP completely fails to qualify as a defensive buy. But let's take it a step further and unpack the math live. Using Graham's famous intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share, we get a very clear baseline. If we use AEP's derived EPS of roughly $6.72 and a book value of about $58.16, we calculate a hard, fundamental intrinsic value of exactly $93.77 per share. So, when we compare the current trading price of $134.94 against that Graham intrinsic value of $93.77, it reveals a massive negative margin of safety. Graham was notoriously conservative. There is absolutely no way he touched the stock unless it plummeted well below that $93 mark to offer him true, undeniable downside protection.
Okay, Section 5, let's step away from the historical gurus and jump into the quantitative trenches with DCF and alternate models.
Building a base case discounted cash flow model for AEP means we have to acknowledge reality. That massive $78 billion capital plan will heavily suppress their near-term free cash flow. To model this out, we forecast those suppressed cash flows, calculate a terminal value, assuming a steady 2% perpetual growth rate, which mirrors inflation and regulated rate hikes, and then we discount it all back to the present using an industry average weighted average cost of capital, or WACC, of 6.5%. Finally, we just subtract their substantial net debt to find the true equity value.
Now, this sensitivity table is absolutely fascinating. It shows just how heavily utility valuations rely on interest rates, represented here by the WASAC. Our base assumption, that 6.5% discount rate and 2% terminal growth, puts the fair value right at $105.00. You would literally need interest rates to fall dramatically, dropping the WASAC down to 5.5% while simultaneously hitting a 2.5% perpetual growth rate just to justify a $145 price tag. Under current standard assumptions, the fair value is sitting well below today's trading price.
And applying alternate models only confirms this premium pricing. AEP trades at an enterprise value to EBITDA multiple of 13.63, which is quite rich for a highly leveraged utility. On top of that, if we run a dividend discount model, using their current 2.82% yield and a pretty optimistic assumed 5% long-term dividend growth rate, it points to a valuation closer to $110. No matter which modern quantitative angle we take here, the stock screens as expensive.
Finally, Section 6. It is time to bring all these diverse data points together for our synthesis and final recommendation.
Across the board, the results are incredibly consistent. From the strict Graham intrinsic value of roughly $93 to our DCF and dividend discount models hovering around the 105 to 110 range, the current share price of $134.94 appears entirely disconnected from classic value metrics. Buffett would tell you to wait for a much better price because of the debt, and Lynch's metrics practically scream to sell based on that elevated PEG ratio of 2.46.
Now, make no mistake, the real-world assets here are incredible. With drones inspecting next-gen lines and crews expanding capacity to meet 63 gigawatts of projected load growth from things like data centers and electrification, the business itself is highly durable. But the stock price has essentially baked in all of this optimism and then some. Therefore, our blended expert recommendation at $134.94 leans heavily toward a hold or even a sell for the value-conscious investor. So I want to leave you with this final thought. When a company must spend an eye-watering $78 billion over just 5 years simply to maintain its moat and satisfy its customer load, how much of a discount do you demand before buying in? Great companies do not always equate to great investments at current prices. Keep your framework sharp, trust the math, and never, ever sacrifice your margin of safety.